Hello everyone, it's me the Boss Hog. We're back with a video this time on my wealth updating. I know it's a bit of a surprise to have two videos in 1 week, but we're trying to do better, especially now we have a bit of free time over May as well, for reasons that we may have already touched on in the other video, but if not, then you're going to find out very shortly. Let's do it. All right, so in terms of the overview here, this is a table that I keep on Google Docs. You can see here that I've selected the last few quarters as well as comparing April 2023 to April 25 and indeed 24. Um, I mean, overall, it's really positive in terms of direction of travel. We had really positive movements for both pensions, ISAs, and also premium bonds, where we've been basically building our emergency funds. So that's very substantial now. You can see there's some of the increases that are factoring in the 173k. I've also started to get increasingly comfortable with debt. For those who don't know, I actually qualified as a financial advisor. I have a certificate in financial planning. And when I was studying this 15 years ago, this was already a known practice, but it was one of those things that was discouraged, especially if you were going to be giving financial advice because it was quite difficult to do. People actually find it quite difficult to keep the discipline to move money around, to take advantage of introductory periods, 0% interest, those kind of things. And so it's something I haven't done really for many years. My wife's also very risk adverse, I would say, certainly more so than me, but is also getting increasingly comfortable as well. I typically give my wife sort of quarterly overviews as to how we're doing. And I think between us and sort of sharing this with Discord and now also YouTube, it's just sort of demystified it a little bit. So we have a number of credit cards basically we've taken advantage of sort of introductory periods. Some of them are several years long, 0%, and in essence it's allowed us to build up quite good money elsewhere, either by putting it into ISAs earlier than we might have done. We've got some investments now outside of our ISAs likewise because they're maxed out. And we're in the process of sort of working toward maxing out our premium bonds as well. So that's currently 80,000. Between my wife and me, that would be maxed at 100. So it's all moving in a positive direction, and we're basically loading up on our credit cards. Previously, I also had one with Santander, but that's now back down to zero. And we're sort of just going through the next few as we go. So the next big one to load up is MBNA. I think that's like a 14,000 to 15,000 credit limit as well. So a really good credit limit. So we're just starting to load up on that currently. Barclays credit limit 6.5, Lloyd's credit limit 9. So we still got a little way to go on those as well. So broadly speaking, we're moving in a positive direction there. The mortgage offset likewise as well. You can kind of wash that almost against the premium bonds. That's in essence what we're doing there. The interest works out at more or less the same of what we're sort of having to pay by not increasing the equity in our house versus the premium bonds. And our thinking here was like me and my wife both like a bit of a gamble. We actually, the first time we met was in a pub, but then afterwards we went to a casino because it was one of the few places that was open that late at night. So we've always sort of been fine with an element of gambling. I used to play in side hustle poker profitably as well. So, I have a somewhat tolerant wife when it comes to gambling. And overall, we decided that if it was basically going to be a bit of a wash, we didn't need the cash flow immediately anyway. And so we would go for moon shoots and irregular income that you get with premium bonds. So that's our thinking there. So you can more or less take that 80k that we currently have in premium bonds, the 80k that we could put into our mortgage offset that we've basically taken out of our mortgage offset account now, and kind of wipe them out. But I'm showing it everything here for transparency, just from that perspective. So. Yeah, just to reiterate, I plan to increase this moving forward. I'm hoping to be able to get more and more credits. The MBNA one, especially, that's actually under my wife's name. That's the first time we've been able to get her a 5-figure credit limit. The previous one we have on Santander was mine, which was 12 and a half. And then Barclays is in her name, Lloyd's is in my name. So we're basically just splitting the credit scores and everything else. You do see a small impact when you take out multiple credit cards and things like that, but then you also get the advantage of not having utilized all of your debt. So there's an advantage of that as well. So my wife especially has a perfect score at the moment, literally 909, and mine is less than perfect, but it's good enough to be getting sort of 4 and 5 figures. So that's been again very useful from that perspective. The other important thing to mention is that both Wifey and I are running ahead of my expectations when I originally did these numbers, especially my wife's. My wife's seen a kind of verging on a transformative jump in her career, and potentially next year she's going to see another jump. She now works in private equity where the money is very good. And she's already a director, so the next couple of steps for her are sort of senior director and then into the VP worlds where it gets very lucrative quite quickly. So originally when I did these projections, I think she was on 60 and I was on 80. My latest role was on sort of 113 and hers is on 95, but with much bigger bonus possibilities. And she's also got a long-term incentive as well, where she gets basically bankrolled into investment vehicles that her company does. So a little bit unusual, but my understanding is that's quite common in private equity. So those haven't really started to vest yet, but would be quite lucrative as they do start to come online over the next couple of years, sort of a couple of hundred every month to start with, and then it only builds from there the longer that you're there. So that's been very helpful, and we are therefore in a pretty comfortable position because of that. However, I am currently unemployed as of the 1st of May. This was quite an interesting one. So I joined my last employer as part of a finance shakeup, basically. I joined practically alongside a new CFO and a new FD. And it was our job to professionalize, upgrade systems, processes, people, that kind of stuff, outsource where we could, save money and renegotiate elsewhere. And that mission has probably been materially done for at least 6 months. My CFO and FD have already moved on. My FP&A peer also moved on, and it was pretty much like mission done. I sort of stayed a bit longer just to wrap up a couple of things, one regulatory item and one sort of B2B structural planning, which I really enjoyed actually. That was a fun project. But if I'm honest, I haven't been super happy at work for sort of 6 months just because I felt like my reasons for being there had been done. So when I had an opportunity to leave, it was something I jumped at. I and agreed some terms, and what that means now is I am free and kind of enjoying May to myself to reflect, to work out what I want to do next. So although we're in a comfortable position, though, the long story short here is that there is an element of me burning through money at the moment. My take home beforehand was like 5.8 a month. So it's relatively significant amount to not be having. But again, we're in a relatively comfortable spot, as we'll touch on next. So let's have a look at the details of why I'm feeling fairly relaxed, even though we're now a one income household. All right, so these are my costs as they stand currently. And when I say my costs, these are all the Boss Hog family's costs. So I'll just go through a couple of the bigger ones here. The mortgage, we've recently remortgaged, and we actually did this on a 15-year term. So with the plan being that we're gonna pay off as much as possible as quickly as possible, build up our equity, because our plan when we next move is to get our forever home. So we don't know exactly how much that's going to be, but I imagine it's going to be somewhere between 800,000 and a million. The very much intention of that is to sort of get a four bed in a sort of semi-suburban area in London. But yeah, relatively, well, no, a very serious investment there. That sort of changed actually from when I was originally doing this proposal. I imagined we would have a more humble home for a lot longer, potentially forever. But my wife especially would like a bigger home. And to be fair, there are elements that I sort of miss, like, when we go around my daughter's friends and their parents, they have, many of them have much better sort of hosting setups, like really nice kitchens that lead out into gardens and things like that. So there's an element there of like me and my wife love hosting, and that would be nice to do. Plus, it would be nice also, if we could get like grandparents round, aunties and uncles round, just have a little bit more of sort of a family setup. Our sort of two bed, two bath at the moment is not really very conducive for that. Like it's a fine flat, there's nothing wrong with it at all, and hopefully it will get a reasonable resale value. But we moved in sort of 9 years ago and actually at the time we could barely afford this. It was 1% above our budget. But and therefore we took out a 30-year mortgage originally that we've gradually been ramping down and sort of seeing our monthly repayments go up deliberately as we've responded to better income. So we've taken this from 2200 to 2800, but a significantly shorter payback period, enabling us to do that. School fees have already gone up modestly for us, about 11%. We got lots of a letter from the school saying it's being cushioned this year, but we're very much expecting no cushion from September next year. It'll also be interesting because, like many private schools, our school does a lot of stuff, sort of free stuff for state schools as well. So they're sort of looking at also whether they need to cut any of that, what that's going to look like, etc. So the ramifications of this will be interesting over the next few years. Certainly for us, like most of the people that we go to school with, the parents aren't retired and sort of swimming around in the Cayman Islands. They are sort of lawyers, doctors, financial analysts, that kind of stuff. Like they're actually very much working people. To I imagine most of them are earning six figures. It's not like they're struggling or anything. But they're working professionals. Yeah, a bunch of lawyers especially seem like if ever I need to find a good lawyer, I just have to sort of contact the parents groups. Funny the way that works out, but also yeah, many doctors and then analysts probably in the third position as well. So that's interesting. It's actually quite nice. One or two of them are sort of on the more creative side, sort of photographers or people who work in marketing and things like that. They always sort of it's nice to have a balance, somewhat, and that they you can sort of tell them they're quite different people as well. So that's nice to have that blend there. I love my daughter's school. I picked it. I got a bursary when I was a lot younger that transformed my life, frankly. I'm a big advocate of the importance of education, so no plans for us to move my daughter out of that. It's very much something we want to continue doing, despite the increases. Basically, as long as we can do it, we will be doing it. So that's that. Similarly, as well with the after school club there and the activities, these are things where my daughter likes the after school club, most importantly. This is sort of between 3 and 6, and typically we aim to pick her up between half 4 and 5. But especially in May, now I'm not working like today, I'm going to go and pick her up at 3. And a couple of days a week now, we're just having some nice daddy-daughter time in the afternoon, which is also reducing these costs, right? So that's something that's an element of flexibility here. Most of our other bills have increased. A lot of those increases came in April due to new rounds of regulation and things like that. So the water bill went up quite a lot from 50 to 69. So 40% increase effectively is quite a rough one. The school fees I've already touched on. The mortgage a little bit unrelated, but that's also gone up from April. And then we've also got things like, our service charges continue to feel like, being gouged. To be honest with you, I'm not enjoying those at all. And council tax also went up substantially, like 15%. So that's another nasty one as well. So a lot of these have been increasing. Luckily, our income has also been increasing, like I say, notably my wife's. But it'll be interesting to see what happens both in terms of our income and our expenses. My wife currently takes home about 5.1k a month, of which 4.7k typically is transferred into our joint bank account. And that's there, the income figure you can see at the bottom there of 4,700. So just to explain what that is. And then you can see what that means in terms of our monthly net cost. So in essence, at the moment, we're bleeding 2 grand, depending on how you want to look at it. Though you could say, well, actually, you're bleeding more than that because I'm not bringing in my 5.7, 5.8k that I was previously bringing in, right? So depending on that. What that means then in terms of run rate and why I'm not especially concerned at the moment is because now if you look at the table on the right, this is our current position actually as of today. So yeah, if I open bank accounts, etc., this is where we're at today. So it puts us with our gross cash position of 26k. We've got a couple of expenses toward the end of the month. We're going hiking in Poland, in Zakopane. So some of those things are already committed, but otherwise all of our big bills for this month are basically paid. And what that really means then is our net cash position of about 25k. So this sort of covers us for sort of 12 and a half months, potentially even a bit longer if we make some relatively modest cancellations and reductions in our spend. I've highlighted those there in the savings, but to be honest with you, there isn't a ton of savings. And part of this is sort of deferred, like my daughter's ISA and things like that. So, we've already gone through this process previously. There's one or two things here we can probably relatively straightforward save a couple of hundred, honestly, just by being a bit stricter or maybe not having one or two things that we currently have. But it's not going to be too transformative. Saying that, it does delay things 3 months, so there is an element to that as well that we should at least consider. And I'll be catching up with my wife and sort of running these by her. The other important thing to mention is that this is purely our liquid cash position, and by that I mean cash and credit, right? Things that we can go to the ATM or you spend in the shops without any issues. We've also got 80k in premium bonds, although I'd rather not touch that because that's sort of in my head almost like a mental offset where we've got 80k that we could be contributing more toward the house, and maybe one day we will, like when we get offer of a home, um, versus premium bonds. So that's to me like is a mental contra in my head. But we've also got our GIAs, which is sort of more what I'm thinking as our fallback here. So if we need the cash, so I've got, I added 12k in early April, and that's outside of our ISAs. So to me, that's something where, that's a nice to have. I do have it in stocks, so obviously it's not the best emergency fund, but again, I'm relatively confident that things aren't going to crash too much. You can never tell. But even if they do, again, we'll take a sensible approach. Like if it does truly crash by 50% suddenly, then instead we'll use the premium bonds. So it's not like I'm necessarily wedded to it. I do have that little bit of flexibility there. But really, the plan is to use our cash positions. My wife's going to be adding, the better part of 5 grand every month. And also the other thing to factor in with this, like my wife very much should get a bonus at the end of the year. So maybe when we start to run out of money, there'll be a bit of a cash injection from that. That will likely be 5 figures, and would be a useful top up. Very much though, I sort of see this as not something to be lazy about. Like in an ideal space, I would be having a job, let's say by July, August time at the latest, and therefore this would all be unnecessary, and we'd just be in a great spot. If I can get a job paying similar, then we would just be very comfortably ahead of our targets and not have to use this, and etc. So this is almost like to put mine and my wife's mind at ease, show you my thought processes. Actually, I think it's been a long time, honestly, since I shared my costs with you guys. I suspect you'll be very surprised by some of the high amounts here, but that's the reality of a family living in London with private schooling. So it's probably not too surprising for anyone who does live in London, but yeah, potentially hear some of these figures for those of you up north or indeed elsewhere will be quite significant. What this all means in terms of how we're doing for our long-term planning, though, let's touch on that next before we round off. All right, so the road to 1 million remains in a good place, honestly. It's been an interesting ride, especially since, the Liberation Day and the tariffs and everything else. That's largely what caused that big slump there. We were starting to accelerate away from the blue line, got brought back to reality, had a bonus and things like that at the last pay before I left my job. So that's now put us back above the blue line, and also the market started to recover now. A lot of our positions are improving, but some of my big tech positions are still sort of 10 to 15% below their all-time highs. So actually, I'm quietly confident that as things recover, especially as I doubled down and bought like 50 grand's worth of more stock, primarily in those big tech positions, that will continue to benefit. So that's the hope here. The target remains to hit 7 figures by December 2027. This is why I would class my medium-term target. We'll touch on my long-term target very shortly for anyone new here. But again, the blue line here in getting to 1 million by the end of December remains on track. We're currently 32k ahead of expectations. I expect this to be used up fairly quickly. It's very much dependent also on the market. And so, I just really focus on, are we contributing? What does that look like? Rather than worrying about the vagaries of the market, which is very volatile at the moment. But yeah, broadly speaking, with so much of our wealth tied up in markets, both, we've got 300 grand in our investment portfolio, plus, the better part 200 grand now in our, or 150 to 200 in our pensions, which are also basically exposed to the market. Actually, a big majority of my wealth is exposed to the market. So, which isn't really something I can control and isn't actually something I'm particularly worried about, especially with a 20-year time horizon. I actually get quite excited when I have an opportunity to buy cheaper, which is why I chucked 52 grand into ISAs and general investment accounts in early April. I just want to round out here by reiterating, and this is something I mentioned in Discord, but I just want to reiterate here that I continue to believe that my early targets were too ambitious. Like when I started this, it was in September, October 2020. I was quite naive in many ways, and so I didn't give enough credit to sort of the way the hockey stick works. And so really, I think that until quite recently, although it started to show in sort of 22, 23, where I started to fall behind, like really we've been flattered by the market. I don't think I should really be above the blue line. It's only because you've had a couple of really great years. And I think actually what will happen is that we're in a good space to actually start exceeding certainly our early stage targets. We're running ahead because of the improvements in income against my expectations, and the behavior of the market over the last few years has been generally positive and above averages that I expected in these projections. So I think, the only thing I would say maybe to mitigate that is costs are also substantially higher than I expected when I was doing these expectations, but our income has risen faster than our costs, which therefore has put us in a better spot. So against these targets. So I think we've been flattered certainly to this point, and even if we fall behind the blue line, I'm not going to be overly concerned unless, I can't get a job for many, many months or some other calamity happens. But broadly speaking, we're confident we should become a millionaire by the end of 2027, which is kind of exciting. It doesn't feel that far away anymore, and yeah, it actually feels quite surreal saying it out loud. But that's the target there in our medium term. But I also want to just touch on long term, especially if anyone's new. I realize I haven't done this video for a long time as well, so let's just have a quick look at those before we finish. All right, and here is our long-term road to 5 million. Specifically, I mean, I haven't looked at this for a long time, and when I did, I was quite surprised at how far we are along. I felt like the last time I looked at this, I could barely see the red line, whereas now it's actually, what, 20% of the way along, maybe not quite, but it's now actually starting to go. It still looks very small. You can still barely see it, certainly when zooming out this far, but it is progressing faster than I appreciated. When I sort of unhid those future years, I was like, oh wow, we're actually moving along this graph pretty quickly. The reason that this goes to May 43, that's when I turn 55, so I will very much be stopping work at 55. That is at least the assumption. Many people have said to me, well, actually, as you get closer to that, you'll want to work. Maybe that's true. But actually, for me, it's really important. Like, I can be a bit of a procrastinator. I will very much sort of use the last minute to get things done. And for me, it's therefore important. I have this really strict date to make sure that I don't deviate from this plan. It's kind of to keep myself constrained in a positive way and constructive way. And if I do get to 54, hopefully I will be in a good space and my wife will be in a good space, and then if we choose to work or side hustle or whatever else we want to do, great. We can have those options then, right? But the important thing is to have those options to be able to retire at 55 and to not waste time over the next couple of decades. It was also very important as well. Like I started this journey when my wife had just given birth to our daughter. She was sort of getting over postnatal. And she was very much like, well, do we have to do this? Maybe I want to have, another year or two of fun. And I sort of wanted to sort of keep us honest as well. And I was like, well, we can do that, but it's going to actually have an outsized impact because I'm stopping work at 55. I don't know about you. And for me, like, I can have a retirement that's pretty broad in terms of what it looks like. My wife has slightly more expensive tastes, and it was very much a good way of not just getting me in a kind of more long-term outlook, but also my wife as well, right? So that once we started that journey, it makes it much easier to do these things when you're doing them together, honestly, for anyone who's maybe struggling to get their partner on board. That is definitely a challenge. But I think first of all, like you have to keep you as an individual accountable, and then you can work on keeping those around you accountable. And then once you get that sort of good feedback, now, me and my wife will make decisions in the short term that are maybe suboptimal. Maybe we'd rather go for a more expensive meal or a better holiday. But we'll be like, do we really need that more expensive meal? Or, can we get a nice meal at Nando's? Do we really need that 5-star holiday? Or can we get a 4-star one elsewhere instead, right? So it's those kind of like, it's a sacrifice, but it feels like a relatively modest sacrifice, especially to make sure that you're aligned and working on these things together. So yeah, the plan here is to retire when I'm 55 on 5 million. I will probably keep working until I'm 55, even if we exceed 5 million. Like at the moment, we're on target to be about 5.2 million. That's why the graph goes off here slightly before then, like May 42, I think. But again, my mind here is made up that regardless of what our portfolio is in May 2043, I will be stopping work. Whether it's above 5 million, on 5 million, or below, that will be me done and I'll be thinking about what I'm actually going to be doing in retirement. So that's again something to focus on and to keep you really strict. So again, we are progressing. It's still the better part of 2 decades away, but as this graph shows, we're now somewhat along that journey, and we will just keep this up, hopefully positively, over the next sort of 18 years. Anyway, I've got nothing else to add, so that's where we currently are. Hopefully, that was an interesting update. I'll get back to doing these more regularly, especially as I'm not working at the moment. Thank you very much for watching, everyone. I've been the Boss Hog, and good luck with your wealth building. Bye for now.